Does it ever feel like you're a marketing professional just speaking into the void? But with LinkedIn ads, you can know you're reaching the right decision makers, a network of 130 million of them, in fact. You can even target buyers by job title, industry, company, seniority, skills, and did I say job title? See how you can avoid the void and reach the right buyers with LinkedIn ads. Spend $250 on your first campaign and get a free $250 credit for the next one. Get started at linkedin.com/campaign. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
I must admit, I was a smidge worried going into this week that we would not have enough questions for a decent length show. But we got them. Thank you. You sent some questions in at talkingrealmoney.com, and you bravely chose to speak them with your voice. Thank you so much, because I like them better that way. It makes the show more fun. Hello, everybody. I'm Don McDonald. This is the Friday Q&A edition of the Talking Real Money podcast, and this is where I answer questions, thus the name. You send them in at talkingrealmoney.com. Well, you speak them in on the contact form there, and then I try to answer them right here. You can also ask questions with your fingers and type them, same spot. Or this is kind of cool, on a Saturday, you've got a really great opportunity to just have a conversation with us, an actual, give and take, by calling between 3 and 5 Eastern, this number, 855-935-TALK, 855-935-8255. So, without, as they say, further ado, let's do the first question of the day.
Hello, gentlemen. I called into the show a few weeks ago and was disconnected due to my spotty cell coverage. The question was regarding creating a taxable brokerage account for my wife and me. Even though I couldn't finish the question, yours and Tom's answers were very enlightening. My follow-up question would be then, when would be an appropriate time to open a taxable brokerage and fund it with equities? My idea is 80/20 AVGE SGOV. This is a long-term savings account, and the rule is to not touch this money unless the 6-month emergency fund is depleted, which is hopefully never. I feel like I'm losing money to inflation when it's not invested in equities. Should an additional rule be to only fund this account when both the 401ks and Roth IRAs are fully maxed? I look forward to your thoughts. Thank you.
Well, you kind of answered your own question. So, I would, generally speaking, all things being equal, we're broad generalists here. We have to because the audience is big and I'm not really speaking to your particular situation. But generally speaking, you max out your 401k at least up to the match, if not beyond that. And I think beyond that's great because of the tax advantages. You max out your Roth IRA, again, because of the tax-free nature of them. They're great, long-term saving for investment vehicles. They're awesome at that. Taxable brokerage account is still good at it. It just doesn't get the same level of tax breaks. But if you focus your equity portfolio in there and you use ETFs, the capital gains treatment is advantageous in a brokerage account. So it takes away some of that downside, at least of the like the pre-tax accounts. So I like the idea, but again, you answered your question. Max out the others first, and it makes the decision really simple. You have nowhere else to go, and it also proves you're a darn good saver if you can max out your qualified accounts before you go with a regular old taxable account. Thanks for the question. I really appreciate it. And here's the next one.
Hello, guys. Love your show. Been listening for years. And today I heard you say there's a lot more people buying than selling. Now, I would like to know, how can that be? You can't buy something unless someone is selling it. And I mean, in my mind, in order to buy something, someone has to sell it. So I would think that there are the exact number of sellers as there are buyers. Please comment on that. Thank you.
All right. When we say there are more buyers than sellers or sellers than buyers, there's a degree of facetiousness to it. It's not that there are literally more buyers than sellers when the markets are rising or have been rising. It's just that there's more buying demand than there is selling supply. Absolutely. For every sale, for every transaction, there's a buyer and then there's a seller, a willing buyer and a willing seller. However, if the demand is higher than the supply, as it would be with more buyers than sellers, again, facetiously, because we know it's going to match up. If there is more interest in buying stocks than there is in selling them, well, the buyers need to raise their prices. So let's say you have a stock that's trading for $30 a share, and you bid $30 a share for the stock. Well, suddenly the supply dries up, and nobody is willing to sell it to you at $30 a share. The sellers out there are saying, nope, I think it's worth more. So now you go, okay, I'll give you $30.50 a share. And the sellers go, no, still not good enough. So now you bid $31 a share. Somebody goes, okay, that was the number. That was the number I was thinking. Here you go. Buy my stock. It's $31 a share. That's what we mean by more buyers than sellers. More demand than supply, or flip that, more supply than demand, and that causes prices to generally fall. So it's not literally more people buying than there are selling. It's that there are more people trying to buy, and to entice the sellers, they need to offer more. Works the same way with real estate. You may think your house is worth $500,000 and you put it on the market for $500,000 and nobody buys it. Well, you're a seller. There may be a buyer. You just haven't found the price at which the buyer is willing to buy. So that's what we mean. And again, it's with a degree of sarcasm. Now we're going to go right back to you because you called in another question right after this one.
This is my second question of the day. You're always touting like a 60-40 bond to stock ratio. But what I'm wondering is if someone has already a lot of fixed income, for instance, a pension and Social Security, let's say $70K, they're living on that. All the rest of their money is in the stocks. Do we still need to put that extra money in the 60-40 proportion? Because really, if we can live on that pension and stuff, that's our fixed income already. 70K is like equivalent to like 1.4 million fixed. All that other money is just gravy that's outside of my fixed income. It's going to go to my kids when I die. Why should I put that extra stuff in 60-40, or should I just roll with it and, let the market grow it, right? Okay, thank you.
Actually wrong, because you're conflating two different things. You're conflating an income source with fixed income investments. We don't suggest you have a portion of your portfolio in fixed income, low risk investments for the income they can generate. That's not the reason. We suggest them for the psychological benefit. And by the way, there has been a ton of research done into this. If your entire portfolio is invested in equities because you've got all of this income coming in from elsewhere, well, logically, you may think to yourself, I'm okay, so if the stock market goes down, I've still got my income. And maybe you're one of those people who can actually pull that off. But the reality is, if you have 100% of your money in equities, historically, you would have faced a worst-case scenario of a 50% 1 year loss of value. So let's say you got $1 million in your stock portfolio, and you got your income, so you're not worried about your income, but your portfolio plunges 50%. And remember, there is going to be a lot of selling psychological pressure. You're going to see newscasts saying, well, this is the end of the world. The economy's collapsing. Is this the next Great Depression? Oh my gosh, how much worse can things get? There's going to be so much pressure on you to succumb psychologically that you are likely to panic because you have seen your money go from $1 million to $500,000. So if you have 40% in bonds, or 50% in bonds, or 20% in bonds, when the market declines, you can look at your whole portfolio and go, I'm only down to 800,000 or 750 or whatever the number is. I can weather this. It's not as psychologically uncomfortable. That's the reason. It's for psychology purposes. It's for stability purposes. It's for the appearance of a higher degree of safety. It makes people feel better. That's why you do it. But the reality is you should build a portfolio based on what we call your risk profile. Now, that's an interesting concept because that's not just your tolerance for risk, your ability to withstand downturns. That is also for your need to take risk. So let's say you've got all the income you need coming in. Why do you want to put all of your portfolio in something that could scare the living daylights out of you? You don't need it. You don't need it. Are you trying to make your kids rich? Or do you want to make your life a little less scary? So that's another argument. Thank you for your 2 questions. And now we'll take another one that came in through talkingrealmoney.com on the contact form. And here it is.
Hi, Tom and Don. I have a question that pertains to my parents. My mother is 69 and my stepfather is 83. And my mother has a sum of money that she would like to earn a little bit of interest on, but wants it relatively conservative. So I'd suggested a money market mutual fund. And she was trying to determine how to set that up. Of course, if something happens to her, it's going to go to my stepfather. But she had thought about putting my name on the account with hers because she was a little concerned about his ability to manage that money for himself since he is much older. If something happens to her. And I thought originally it would be good to have both of their names on the account, joint with right of survivorship, so that he would get the money access immediately and then have me as power of attorney. I also considered possibly conservatorship, but I didn't know how that would work if one of them passed away and one of them was still living. Ultimately, this money needs to go to the surviving person between the two of them. Just might need a little bit of oversight to make sure that it's used the way it should be. So if you have any suggestions, I'd love to hear what you have to say on it. Thanks so much.
Well, this is one of those answers that you think should be simple, but it's really not simple because you've got the very real problem of an 83-year-old possibly, but not likely, inheriting the money of a 69-year-old. I mean, the odds are she's going to outlive him by a fair amount of time. Odds are, but anything can happen. So I get that he would need the money. Therefore, it should be designated for him should something happen to her. And one way to do that is joint tenancy, which probably the easiest way to do it and the most typical. But this is getting into an area that I think they and you might want to encourage them to address. Because of that widespread and because of his age, if they haven't sat down with a really good estate attorney, it's time. It's definitely time because this needs to be set up in such a way that someone can help take care of his needs if she passes before him. And it's not going to be as complicated if he goes before her, but it is possibly the other way if there are concerns about his capabilities in his latter years. So the answer to this question is not an easy one. It's a complex one, and there's a cost to it. And that is, it's time for an estate plan. It really, really is. Don't just willy-nilly change platings on accounts because you have to think about much bigger issues. And there are some things that you're not going to think about that an attorney will because they're going to look at your situation, at your family situation. Thank you so much for the question. I wish I had a more succinct answer, but that really is the only one that makes sense to me. And let's see. Yeah, we've got another one. We might have 2 more. Let's do this one.
Hi, Don. This is Dustin in Pittsburgh, Pennsylvania. I wanted to get your take on a lifetime strategy to maximize the benefits of an HSA for withdrawals and contributions. So my wife and I are in our 20s, and we wanted to fund an HSA, max it out each year, and be 100% in equities just to maximize how much we contribute and keep and grow and invest. Then we thought in our 40s, until retirement, we could be about 75-25 and have a 3% perpetual withdrawal rate just to keep some growth in there, but also taking some money out to fund those midlife medical expenses. And then after retirement, we'd take maybe a 4 or 5% flexible withdrawal and be about 50-50. So more like a traditional retirement account. But that would hopefully keep some money in there for long-term care expenses towards the end of life. I kind of like that idea, but I've seen some articles from Christine Benz saying that traditional tax-deferred accounts are better because you'll be able to deduct long-term care expenses, assuming it hits over 7.5% AGI. So I wanted to hear your thoughts on how to come up with withdrawal rates and allocations for an HSA over your lifetime so that you maximize how much you're getting out of it, but also keeping some in for those maximum medical expenses at the end of your life. Thanks.
Well, those crickets were incredibly clear in the background. Wow. Shockingly good. I love the fact that you're thinking about all of this stuff in your 20s. I was too stupid to do that, apparently. This is brilliant that you're thinking about it. Now, I don't know if it's the best strategy. I believe the best strategy is to max your retirement accounts before you max your HSA. But if you can afford to do both, yeah, do both. But yeah, and I think you're okay going heavy equities. I don't know if I'd go 100% in that first decade. I'd probably keep a little bit of a cushion so that you don't have to sell your stocks into a down market should you incur some surprise medical costs. And remember, this can help you pay deductibles and copays too with tax-free dollars, basically. So I don't think I'd go 100% equities at the beginning, but I think your idea of having an HSA as an adjunct to your retirement portfolio and then making it more conservative, setting up that glide path as you get older, makes great sense. But again, I think the rule of thumb should just be, and of course it's going to depend on each individual, but I really think in this case, it's fund those retirement accounts first, to at least to the match at work, and then fund that HSA. But I like the idea that you're thinking about all of these things. And the fact that you're thinking about all of these things in your 20s means that even if you mess up and don't do the exact best things along the way, you're still going to be fine. You really will. Thanks for the question. And yes, we're going to get one more in before we wrap this up. Here it is.
I have a question. Is Appella Advice for Life connected to talkingmoney.com? Because I submitted a request to talk to someone and then they contacted me. I don't know. I was a little confused about the whole communication. If the place is Appella Advice for Life.
Yes, they're the same thing. They are. Talking Real Money is part of Appella Wealth. Tom and I work for Appella Wealth. It's called Appella, Appella, but I can see why you'd call it Appella. And they are a registered investment advisor with which actually we merged. Tom and I had a firm called Vestory, and we merged that firm with Appella several years ago. And so instead of offering it through Vestory, we now offer it through our firm Appella, and we're partners in that firm. So as a matter of fact, on the form you filled out, when you filled out the form at talkingrealmoney.com, it says Talking Real Money listeners can meet with an Appella Wealth advisor. It's right there. So yeah, we are part of Appella Wealth. There's even a link there to Appella Wealth right from that page. And so don't worry, it's one and the same thing. So if you ask for help, for the free help we offer, which is really free help, not a sales pitch, you will be set up with an Appella Wealth advisor. One of those might even be Tom. In fact, if you ask for Tom, he'll meet with you. So yeah, Appella Wealth and Talking Real Money, we are one and the same, basically. Thanks for your interest, and go ahead and meet with that advisor. And if you'd like to meet with one of those advisors, all you have to do is go to talkingrealmoney.com, click on the button that says Meet an Advisor, and right there on that page it says everyone needs a little help now and then. Talking Real Money listeners can meet with an Appella Wealth advisor at no cost obligation or high-pressure sales pitch. Just fill in your information and somebody will get in touch with you. It's that easy. And if you have questions, we answer them on this show and we answer them on other shows. If you type them in at talkingrealmoney.com, can't tell you for sure when it'll get answered, but listen to the podcast. If you speak them in, they will get answered on the Friday podcast. That's the way that works. And if you want to call us and actually have a conversation with us, every Saturday we do a radio show in Seattle, and you can call that between 3 p.m. and 5 p.m. Eastern Time at 855-935-TALK, 855-935-8255. And thanks so much for listening. Please tell a friend or two or 10. Sometimes I say 1,000, but I don't know too many people who have 1,000 friends, except maybe my wife. So 10 would be good. Tell 10. And keep listening, because there's not much that is more important than talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.